All right, just a few minutes left until the closing bell. Joining us from the CME Group in Chicago is John Brady, Senior Vice President at MF Global. John trades fixed income futures and treasuries. Also with us is Keith Springer, President of Capital Financial Advisory Services. He says the markets are still trying to digest last week's gains, and he remains bearish in the long term. John, Keith, thanks for joining us. I want to start with you, Keith. Bearish in the long term? Why is that?
Well, the fundamentals are terrible, and they continue to be terrible. We've had GDP come in much lower than expected, and it's showing you that with $12 trillion in stimulus, you just can't get any kind of growth out of this economy. The problem is very simple. For an economy to grow, you have to have more aggregate demand. Well, we have an aging population that's just going to have less and less demand, which is going to require less goods and services, less supply, less people working to supply that generation. And it's a very simple, zero-sum effect. You can't possibly have any growth in this economy with this type of population that is aging continuously, and the demographics point to a downturn.
So what do you think about the number? What do you think, Keith, about the number tomorrow? What should we be looking for the big non-farm payrolls?
Well, it's funny because what's expected and what's realistic have been two different things. The ADP numbers that have come out have actually been pretty accurate. But even yesterday, 67,000 jobs in this type of recovery at this point, that's next to nothing. We should be seeing large numbers of job increases, and we're just not seeing it. And what happens when the stimulus goes away? What happens when people start saving more? They start repaying their debt, deleveraging. It's an endless spiral until the next generation, the larger generation that makes up the difference from the baby boomers, really has some serious demand in the economy and makes up the difference and can really propel this economy.
John Brady, do you share such a bearish outlook?
I do, but I'm going to take a little bit of a different tilt. Matt, there's been some tremendous disappointment in the last couple of weeks in the market. It only seems to be accelerating in the fact that we just recently received about 2,300 pages of financial regulation, yet that financial regulation did not touch upon any reform whatsoever as it relates to Fannie Mae and Freddie Mac. And as you know, we believe that much of the epicenter of deflation within this economy, which happens to affect the income and job markets as well, much of the epicenter of that deflation remains in the housing market. And without any sort of fundamental or meaningful reform of Fannie or Freddie Mac, the potential for deflation to intensify from here is only increasing, which will make the physical as well as economic challenges of the third and fourth quarter that much more challenging.
Get back now to John and Keith. And John, let me get your expectation for the big number tomorrow, and how important is it to people on the floor?
Well, it's very important, Matt. I think it's going to give us a little bit of momentum going into the fall quarter. And as you know, the second quarter economic data really started to fall off a cliff as we came out of the month of July. So there is risk here. I think what the market's going to focus mostly on is going to be private payroll growth as well as the unemployment rate. Now, the unemployment rate is expected to uptick to 9.6%. There are some, like MF Global's Jim O'Sullivan, who look for a number maybe closer to 9.4%. But if we see a stab above 9.6%, Matt, I think that's going to probably make the markets a little bit nervous. Look for S&Ps perhaps to retest that 1107 even level. That's your 50% retracement from the 3-month range. But private payroll growth, too, there's a pretty strong correlation between weakness in the Michigan sentiment data and a lack of growth in private payrolls. And if that surfaces again tomorrow, again, the economic challenges for the third and fourth quarter may only be intensifying.
Hey, Keith, let me ask you how you position yourself for your bearish outlook. I mean, short term for tomorrow's number, and then longer term, what do you get into to stay defensive or even to profit off drops?
Well, I think it's really important for investors to focus on the safest way to get good returns. That's what we do for our clients. I've been focusing on income, dividends. Income and dividends have provided over half of the return of the stock market for many years, and more than 100% for the last 10 years. You look for corporate bonds, some returns on dividends, preferreds, some MLPs. I think it's critical that people protect themselves going forward because the market's been very resilient to bad news. It's almost bad news is good news and worse news is better news. It really has been very resilient. It could be the investor sentiment figures are so low that the market can only climb that wall of worry and go up. But who knows when a crisis of confidence is going to come. So we focus on income, dividends, trying to provide the safest way to get returns for our clients so you don't have to take all the risk but still get great returns in return.
Hey, Keith, it's tough out there. IBM does a bond deal this week. Three-year paper with a 1% yield. So where do you go? I mean, 3% or 3 years, 1%. I mean, where do you go?
Well, you can go down the line a little bit because the corporate bonds have typically a very low default rate, even some of the lower rated bonds. And we've got to remember some of the TARP companies have more or less an implied guarantee, so to speak, from the government. You can buy GMAC paper and get 5, 6, 7% 3-4 years out. You can buy AIG paper. You can go down a little bit and find some other paper where some of the big money managers, the high quality money managers, where Bill Gross might be buying, and pick up 5, 6, 7% yields, some even a little bit higher, 8, 9%. MLPs are yielding 8, 9% and offer good returns. Some preferreds are still at 8, 9%. So there are places to find these returns. The key is to limit your risk. Too many people just simply take too much risk, Matt. They'll buy a bunch of stocks and hope they go up, that sort of buy and hold or buy and hope mentality, when you've got to be very tactical in this environment. And for instance, that's what we do. We're tactical, and you've got to be prepared for what the market's going to bring you.
Back to John and Keith. And Keith, let me ask you what you think about consumer staples. I mean, what industry groups do you like? If you're bearish, don't you like these very defensive stocks?
Like defensive stocks, as long as the dividends can be withstood. That's the most important thing going forward. The problem is, as we learned a couple of years ago, true asset allocation, where you buy everything across the board, goes down when everything goes down. So I really want to focus on things that have less beta, less volatility than the stock market, higher dividends than normal, as much income as you can bring. That earnings report you just announced was very interesting, because I'd love to see if it was top, earnings growth oriented, or was it from cost cutting? And that's what we continuously see. And you can only lay off so many people. And before the market is going to want some validation. We can't keep having good news be bad news and worse news be better news. Eventually, this market's going to need some validation.
Absolutely. And John, I want to bring you to the discussion here, because he talked about this idea of going into bonds and dividend paying stocks. TIPS, Treasury inflation protected securities, and 10-year bonds. That spread is very small. No fear of inflation, right?
Well, not right now, Matt. No. In fact, the fear is deflation. I think Mohamed El-Arian of PIMCO made a suggestion that the odds are 1 in 4 that we could get a little bit of a deflation scare here rather shortly. No, there's no inflation. And likewise, too, the talk about commodities and Russia perhaps no longer exporting grains and wheat. The fact of the matter is, you cannot have any type of inflation scare if you don't have income growth. And so commodity prices can head higher, but at some point they will become hostage to a lack of income growth, and any sort of oversupply will develop.
All right, hey, John, thanks so much for joining. John Brady there from MF Global, Keith Springer of Capital Financial Advisory Services.